Okay, very final bit. How are we doing for time? Doing well. Very final bit. So if we have an operating sale and leaseback. So in this case, it's a little bit different because a sale has happened. Because if I'm going into an operating lease, I have not taken back the risks and rewards of ownership. I do not have control. So legitimately, the asset has gone off my books. That's okay. How we deal with it is if the sale price, so we're going to use that $120 million sale price at the moment. So I have an asset of 100, I sell it for 120, and that sale price is a legitimate fair value sale price. I can show that $20 million profit because that's all above board. I've then leased it back legitimately. We're all fine. The second method, or not the second method, the second situation is if the sale price is less than the fair value. So let's imagine I sold it for $120 million, but the fair value for that asset, for whatever reason, was $130 million. In that case, in that case, the profit and loss is recognized. Because when you think about what the concern about standard setters more generally is, they want to stop people doing things too well. They want to, not too well, they want to stop companies overstating profits rather than understating profits. So, because I really don't understand, I mean, I definitely know there are situations where this happens, but for you guys to think about, why would a company sell an asset for $120 million to somebody? So if I sell it to you for $120 million, when I know I could have gone out to the market to somebody else and got 130, why am I selling it to you and not somebody else? And that there are some problems with that, but they're much more concerned with if you sell it for above the fair value, not below the fair value. If the sale price is greater than the fair value, and this is obviously a concern for them. So if I sell it for 120, but the fair value was 105, use you again. You guys are the market. No one is willing to pay more than 105 for it. Why is he buying it off me for 120? Is there some other deal that's going on? Is there something else that's happening? So in that case, anything above the fair value, so you get to show the first $5 and that comes through as profit. The rest of it will be deferred and amortized over the lease term. So the $5 you get to recognize, the remaining 15 that seems to be a little bit problematic, that sort of gets doled out over time. And the very last situation, just to finish things off, if the carrying value is greater than the fair value. So I have that, remember I had that asset on my books at $100 million, but the fair value is 75. If I have property, plant, and equipment on my books for 100 and the fair value for that is 75, what would that tend to suggest that I need to do with that asset? Think about what you're doing and writing right at the moment. For Monday. You can't be concentrating so hard on the stuff for Monday that you've completely forgotten what you've been writing. I know it's intangibles, but what is the situation that you're dealing with those intangibles? I'll give you a hint, it starts with I. It's an impairment. You've got an asset which is impaired. If the fair value, it's more than likely it's impaired. So if the carrying value, if it's on my books at 100, but the fair value is 75, you take the hit straight away. That comes down, you show that $25 million as a loss immediately. So even though it doesn't technically talk about an impairment, that is effectively what's going on there. And then from 75, you figure out what's going on with the sale price, which is probably going to be 75, meaning there's no profit and loss recognized. Because it's on your books and it's 75, you sell it for 75, there is no profit, but you've just had the $25 million impairment. Done. And that's it. With a final note on leases, and I'll put some of this information up online for those that have the time and or inclination to have a look at it. So leases, just to give you a really broad overview of what's going on. The main distinction that we've talked about, and this is a good summary of what we've just done, the distinction at the moment with leases is an operating and financing. They talk about the risks and rewards of control going across and all those other things that you need to look at, the vibe around it. That tells you it's operating, and then you record it on your balance sheet, you capitalize it, you deal with the assets, you deal with the liabilities, you do all of the various subsequent measurements. If it's an operating lease, debit, expense, credit, cash, that's all you need to do. The idea behind at least this exposure draft, and you can see it's pretty recent. I mean, the comments were due in mid last month, and I know I've seen some of the summaries of comment letters, but I don't think it's for leases yet. The essential idea, and there's a few wrinkles in what they're doing, but the essential idea of what they're doing is saying the distinction is around 12 months. Any lease longer than 12 months, we want to bring on balance sheet, and it's a slightly different model to what we're talking about here, but anything in essence above 12 months, bring on balance sheet. Anything under 12 months gets expensed out. That's a very, very high level idea of what's going on. There are some issues with how they're dealing with it. Whether it gets up or not, we shall see, but if anyone is interested in reading some of the summaries behind how that works, I will provide links for them online so you can have a look at that. Obviously, that's not likely to be this weekend because I understand that you guys will more than likely be busy, but for when you want to. So you should have an idea why economically leases are important, also why there are problems in the accounting. We've just talked about those. Be able to apply the regulation and think about what's happening down the track. For next week, we're looking at tax. As fun as that is, it is actually interesting, and it's also interesting from a theoretical perspective because we have these things called deferred tax assets or deferred tax liabilities. Are they really assets and are they really liabilities? But we'll explore that next week. Consults at usual times, drop-in class at usual time. Most of the stuff that we're doing is available on the web, including the lectures are now going up on YouTube. So if you do happen to miss something or wish to review anything, they are available there as well. Otherwise, enjoy your weekend, and I shall see you guys next Friday. Good luck with the assignments. I expect to see them all in Monday afternoon.